Hi, this is Matthew Cratter from Trader University, and today I want to talk about the ongoing stock market crash, as well as the crashes in gold, Bitcoin, oil, etc. I want to give you sort of the big picture so you know where we are on the roadmap. If you're worried about this bear market, stressed about these markets, or just want to see how I'm trading it, be sure to hit that subscribe button now. So obviously another big day down. We're well off the lows. We were down well over 10% in all the indices today. But another very brutal day, especially for very large market cap companies. I mean, it's amazing to see something like Apple trading down almost 8%. Now, in the real economy, there are a lot of knock-on effects from this virus. Huge layoffs. You can see here, SAS laying off 90% of their workforce. And you can just imagine the ripple effect in terms of how this affects those people and their families. Now, over the weekend, we got a massive interest rate cut from the Fed. They basically cut to zero, or range between 0 and 0.25 basis points. They launched a new program of quantitative easing, and then you can see at the top here we just got some breaking news that they're going to be trying to prop up the overnight repo market. So let's just zoom out and ask ourselves what's happening here. If someone asks you what's happening, the answer is this is a liquidity crisis. A liquidity crisis is basically where investors panic, usually globally now since we're all interconnected, and everyone rushes to raise cash. Now, maybe your stock goes down, you've been trading on margin, and so you're forced to sell. Maybe you're a hedge fund that's getting redemptions, or a mutual fund that's getting redemptions where people are asking for their money back. And so you basically have to sell assets at any price that is available. And so what you're going to do is you're going to sell the most liquid assets. You're just going to dump and try to raise cash, especially if you think you're going to be cooped up in your home for a couple months or you've lost your job. And so this is happening at all levels, from the poorest people to the wealthiest people. Now, as part of this, we are seeing everything being sold off. Gold is selling off. Treasuries are selling off. Bitcoin is selling off. Crude oil is selling off. Basically, people are trying to raise cash however they can. Now, it's very hard, for example, to sell your house to raise cash. But what you can do is you can log into your brokerage account and you can start dumping stuff. Now, there's one market which has no circuit breakers, cannot be closed or anything, and that's Bitcoin. And so Bitcoin has been used as a way of raising cash, and that's one reason it's fallen so quickly. Gold is another one, but only paper gold. It's interesting. So GLD is the ETF. I've been telling you guys that I've been long for a few months now, and you can see it's sold off quite hard in this market, and a lot of people are puzzled by this because they say, gold is a safe haven asset and the central banks could be printing all this money. All these same arguments go for Bitcoin as well. But what's happening is gold, the paper is selling off. This ETF that supposedly holds bars of gold somewhere, and we have to assume that they do, though maybe they don't. Perhaps the safest thing is having bars of gold in your house, but then of course you have the problem of protecting it and stopping home robberies. And so I prefer a paper asset like this. But what's very interesting and what is happening is but let me back up. GLD trades like a stock. It's an ETF. It's very easy to just sell it and raise some cash. And this is what individuals and hedge funds and people are doing. At the same time, though, we are seeing a lot of reports that in the physical market for gold and silver, they look like your local grocery store. They run out of gold. Big dealer told one of my best relationships on Wall Street that physical gold bullion, in other words, gold bars, that they can source is just about gone in New York City. So people are trying to get their hands on the physical gold. But at the same time, people who need to raise cash are dumping the paper gold. Now, this shows you why GLD is such a good buy at this point, because there is underlying demand for this. And as the central bank prints money, both gold and Bitcoin will be forced up. And what really matters here is the physical demand for gold. Now, something similar is happening in, and I'm going to put links to all this in the notes below. Something similar is happening in the U.S. Treasury market, which is basically they're the safest assets in the world, guaranteed by the U.S. government. There have been a lot of strains really since late last year, and that was one of the reasons for my bear market call, just seeing these cracks in the U.S. government bond market. Now, this is why the Fed is offering more funding in the overnight repo market, which is basically how banks borrow money in order to buy treasuries. But at a time when the Fed is cutting rates to zero, you would expect, if we look at TNX, the 10-year note, the Fed is basically trying to get all the U.S. Treasuries, from the T-bills to the 2-year notes to the 5-year notes, 10-year notes, 30-year bonds, trying to get all those interest rates way down. And it was working for a while. We got down to about 40 basis points, but there's been this big spike up in yields, which actually hurts everyone. And the reason for this is because the people who, the banks essentially who hold huge amounts of bonds are having trouble funding it. And as a result, so I've told you guys I'm long the Treasury futures, the T-note futures. The equivalent of this is basically IEF or TLT. And these are suffering in the same way that GLD is suffering. If interest rates go down and continue to go down towards zero, IEF and TLT should be much, much, much higher. But they're not, simply because these are ETFs. It's very easy to sell. And also because there are all these strains in the U.S. government bond market. But one thing you can be sure of is that once people raise enough cash, and once we get somewhat of a resolution to this liquidity crisis, these mispricings will mean revert. So GLD will be much higher, especially if there's a lot of demand for physical gold. TLT and IEF will move much higher, simply because interest rates are going to have to go to zero in the U.S. or go down to maybe even go negative. And so what the Fed has done is they control the front end of the curve, kind of the near-term paper. They've brought that front end down to zero, and now it remains for the rest of the yield curve to come down to zero. Now, how are they doing this? Well, in addition to cutting rates, they're doing quantitative easing, which is a fancy way that economists hide what they're really doing, which is they're basically sitting at a computer, pressing a special button that creates new US dollars. Now, what's the problem with creating new US dollars? Well, for one thing, it penalizes people who are holding US dollars. So the more money they print, the less valuable those US dollars that are in your pocket or your bank account become. And this has really been the pattern since the 2008 financial crisis. The Fed has printed a lot of money, and they do this to prop up housing prices and prop up equity prices. And the unfortunate thing about this is it really does widen the gap between the rich and the poor, because the rich tend to own most of the stocks. The poor tend to rent and not own any stocks. And so when you have the Fed printing new money, they're basically picking the pocket of the lower 50% of people who have the lower 50% of net worths. And this is really crazy if you think about the times we live in. Now, you can just call it quantitative easing if it makes you feel better, and it sort of hides things from the public. But you can ask yourself, why is the Fed printing money to prop up these markets? Now, on the one hand, it makes sense. It makes sense in the same way that a really hungover person in the morning probably should have a Bloody Mary or have some more alcohol. It's a very good short-term solution. But it's also madness. It's a very bad long-term solution because it just prolongs the hangover till later in the day or the night. And that's basically what the U.S. financial and the global financial system is right now. All these central banks printing money, trying to stop the inevitable hangover. Now, a lot of people have been saying the Fed's out of ammunition, they can't do anything else. This is simply not true. They can do this. They can do quantitative easing to infinity. They can print as much money as they want. And one way of seeing how far this can go, I'm going to put links to everything in the description notes below, is we can look at what happened in Japan. So Japan had deflation before the rest of the world. They have sort of slowing demographics. They've got an aging population. They now sell more adult diapers than baby diapers, which is never a hopeful sign. But the Bank of Japan, which is their central bank, they started off by buying treasuries, just like, or the equivalent of treasuries, Japanese government bonds, JGBs. They started buying government bonds, and then things just didn't improve. So they had to start buying, many years ago actually, probably since even before 2013, they have been buying stocks. So you have a really weird situation where the Bank of Japan now owns, I think it's even higher than this now, they own about 80% of the ETF market. So they are actually printing money and buying stocks with it. If we look at Zero Hedge here, the Bank of Japan, which is their central bank, is now a top 10 shareholder in 50% of all Japanese companies. Now, this is what's coming to the U.S. The law probably needs to be changed by Congress to allow the Fed to buy stocks. Maybe they'll buy S&P futures or ETFs. But that's really the next step, is either buying stocks, which will only help the more wealthy people. The other thing they can do is they can print money and just give it out to people. Now, this is probably a more fair solution, just sending people free money in the mail. But again, it's total insanity. And one way to think about this, one thought experiment you can do, let's just say you're going to print money. It's an insane thing to do, and it really devalues the currency. But when was the last time that the government printed money and spent it to help homeless people in the United States? When was the last time the government printed money to do medical research to help solve diseases? They never print money for that. They print money to prop up asset classes to help the rich. Now, I'm one of those people who benefit from that and have definitely benefited from quantitative easing since 2008. But I just want people to know what it is and how insane our current system is. That we're actually printing money, which is picking the pockets of the lowest 50% of people, lowest 50% of people, net worths or percentiles, and we're using it to prop up asset prices. Now, in a sense, you have to do this to stop a stock market from crashing, but it's not sustainable. And where the cracks are going to form, in the currency itself. So the currency is going to become, all these fiat currencies, all these paper currencies, are going to become worth a lot less over the coming years. That's why I'm long gold. And that's why I'm long Bitcoin as well. Bitcoin is very valuable, but as a central bank prints money, Bitcoin will benefit. And we can see the volatility here, but Bitcoin is still not crashed. It has been able to, it's a very volatile thing. It's not controlled by any government. It's not regulated. There are no circuit breakers. And it's a really easy way to raise liquidity because it trades over the weekend. It trades at all times. But what we have now is we have a liquidity crisis, which means that everything is selling off, including safe haven assets like treasuries. And then we have quantitative easing. U.S. Central Bank, the Fed, is printing money, buying assets, which basically means bonds at this point, government bonds, though they might start buying mortgages again. They're printing it and putting it on their balance sheet. So you can see this. This is a chart from the Federal Reserve Bank of St. Louis. You can see how small the central bank's balance sheet was in terms of assets. And then it really ramped up in the wake of the 2008-2009 Great Financial Crisis. It continued to go up and really peaked at around 4.4 trillion in 2017. And then what happened? The Fed decided to start shrinking its balance sheet, letting these securities mature and roll off and not replenishing them. And what happened when they did this, you can see when they started to do this was really end of 2017, beginning of 2018. And they drew it down the entire time in 2018. And what happened was the stock market sold off very, very hard for most of 2018. So what happened is they were forced to grow their balance sheet again. And now if we scroll out, we're going to see that they're going to get back to the highs. They're probably, if you run the numbers, they're probably going to have to print like $10 trillion would be a conservative estimate to just bail everything out. So expand their balance sheet to 10 trillion from about 4.4 trillion where it is now. So this is the situation we're in. We're in a liquidity crisis that will eventually be solved by money printing. Stocks will bottom. Stocks will go back up. Investment bankers and wealthy people will be bailed out of the stock market. And we will see new highs in the stock market in the coming years. But at the same time, what's going to happen is gold is going to keep going up. Bitcoin's going to keep going up. Real estate prices is going to keep going up, especially very nice real estate like California coastal real estate, this sort of thing. And so this quantitative easing is going to benefit mostly the rich. There's a chance that we get just free money. Everyone gets a check for $1,000 in the next coming months in the U.S. That would be probably a more fair solution, but equally equally insane. So I'm expecting this between the coronavirus, the statistics getting worse. I think this volatility continues for quite some time, probably into the summer. Then we have the whole problem of, is the coronavirus going to, even if it goes dormant during the summer, unless there's a vaccine or an antiviral cure for it, we're going to have a very nasty fall and winter next year. What happened with the Spanish flu is it went underground during the summer and it came roaring back in the fall and winter, and it was even more virulent. And that's when it killed most of the people. So that's the real risk with coronavirus. And what it means is until we have a cure for it, we're not really going to be able to rest. The stock market's not going to be able to rest. It's just going to bounce around wildly on good news and bad news. And it's going to be very, very hard to trade. Right now, to help you guys out, I have released my new book. It's free on Amazon for the next couple days. The Kindle version is free. The paperback is just about $7. But go to the link in the description notes below. You can download this book completely for free on Amazon Kindle, and you don't even need a Kindle to own a Kindle to read it. You can actually just read it online if you have an Amazon account. Again, completely free. Download it and spread the news, because there are a lot of really good strategies in here if you choose to trade a bear market. The other thing you can do is you can really sit this one out, because these are very crazy times. We've got a lot of other things to worry about besides the stock market. Taking care of our families, staying healthy, and helping other people stay healthy, especially those with chronic health problems, and the elderly as well. So I hope you guys are all doing well. Hopefully this analysis of the liquidity crisis made some sense. Hit that subscribe button, hit the like button, and let me know your thoughts in the comment section below. Thanks a lot for listening. I'll see you in the next video.